Let's talk about the simulation process, specifically about the chronology of events, as well as the performance evaluation. We are starting out with decision making for quarter one. The decision making of quarter one is basically to organize your team, name your company, and contract for a survey of potential customers, their likes, dislikes, etc. Then we are going to switch to quarter two, where you not only have to analyze the market information that you received from the survey, but you actually have to think about your strategic direction for the firm. Not only do you think you have time, you don't. And not only do you think you can do things strategically later, you can't. You have to think of strategic direction right off the beginning and figure out where you want to be at the end of the game. In addition to that, you also have to set up shop. That's tactical. You have to design a brand or two, you have to set up sales offices, and or you can develop regional web centers. Last but not least, you do have to build a factory, and the location of the factory is really important, and it has to do with the strategy. You need to figure out where your markets will be and what are the implications of having a factory in certain spots of the world, not just in regard to production cost, but also in logistics cost. We then switch to quarter three, where you test market your brands for the first time. You set prices, you set advertising, you create media campaigns, you have to staff your sales efforts or your internet tactics, and you have to determine the production schedule for each of your brands. As you can tell, we already have finance decision, manufacturing decisions, marketing decisions, sales decisions, advertising decisions, and human resource decisions coming to play in quarter three. So while we started pretty slow in quarter one, as of quarter three, you are going to be really busy and it's going to be complex. In quarter four, you have to analyze the feedback you received from your test markets. Not only do you get feedback in real terms, people voting with their money, buying the products you create or not, but you also have to study your competition. See what strategy you think you can deduct from what they have been done in their test market quarter three. You have to look at your operating performance, you have to look at your productivity for employees, and you have to financially look at your performance. All of these things are important in quarter four because you are now setting the stage for quarter five, which is the venture capital strategy and the venture capital negotiations. So you need to probably adjust your strategy that you had in quarter two at the outset and figure out what would be a sustainable long-term strategy for your company going forward. Quarter five. Quarter five is the important quarter, and it's also going to be the quarter with the most work in a quarter. Not only do you have to prepare a one-year business plan for your second year, you also have to prepare that business plan and present it to the venture capital group or the venture capitalists that will be working with you, talking to you in our course. You have to actually ask for a capital infusion, and you at the same time have to negotiate their equity investment. So your corporate strategy with the marketing tactics, manufacturing tactics, sales tactics, financial tactics, which influence the bottom line, are at the core of your presentation for the venture capitalists. That is a very tough task, because not only do you have to prepare your strategic business plan, but you also have to prepare the tactical plan for quarters 5 through 8, and these two plans must be in sync. In addition to that, venture capitalists always want to see the performers, and we go and get into details in quarter 5 preparation on that specific topic. But it is going to be a lot of work where the entire team is going to be challenged to work hard and work together. After the venture capital negotiations, when you know how much money you actually get from the VCs, you prepare and finalize your quarter 5 decisions, and quarters 6 through 8 are basically the international rollout of your campaign. In quarters 5, you start already negotiating with other teams on research and development, because as of quarter 6, you are engaging in research and development for much better improvements for your brands. Some companies want to go it alone. Other companies are working with their competitors to share the burden of research and development investment. At the end of the game, after quarter 8 decisions are finalized and the analysis of the results has been conducted, you're going to prepare a presentation to the board of directors. That presentation is the last activity for the course, and really it is the synthesis and evaluation of your work throughout the course. Not only do you have to evaluate and defend your second year performance, you also have to explain deviations from your original second year plan and justify these departures. So in other words, you have to analyze the current market and why things might not have gone the way you intended them to go, how you changed your strategy as you went along, and what were the results of your strategy or strategic changes. Last but not least, you need to work or present to the stockholders your plan for the future, the medium-term future. And in the medium-term future, I would think it's years number 3 to 5 at the max. That will be the last assignment for your course. Let me talk a little bit about the financing for your team. In quarters 1 through 4, each team member will automatically, and it's automatic in the simulation, invest in the firm. So that by quarter 4, you have $4 million in your bank account that you're using to create your brands, test the market. So in other words, at end of quarter 5, the executive team owns 100% of the company. And you have about 40,000 shares of stock for your $4 million investment, with an initial stock value of $100 per share. In quarter 5, you have the opportunity for equity financing from external sources, in our case, venture capitalists. You can achieve up to $5 million of external funding, but it doesn't have to be $5 million. If your business plan is not strong and the venture capitalists don't feel very good about investing, they might not be willing to give you $5 million. Or if you have a very distinct strategy that does not need the $5 million, you can ask for less. I leave that completely up to you and your deliberations in your team. The venture capitalists in their negotiations will expect a very detailed outline of a strategic plan for the second year, and that includes what kind of target markets you pursue, how you expand your sales channels to satisfy these new target markets, what kind of R&D strategy you will have, whether you have planned expansions and what kind of planned expansion you are envisioning, as well as how are you dealing with quality improvements and also with effectiveness of your human resources. In addition to the venture capital external financing, you can also work with debt financing as of quarter 5. So the bank will actually extend your line of credit equal to 1.5 times the firm's equity position in the previous quarter. So that is a new characteristic as of quarter 5. You have bank financing available. Unfortunately, the banks in this game are highly risk adverse and will call in your loan in part or whole if your debt capacity declines due to unusual or extended losses. What does that mean? It means that you have to be very careful in your financial planning, and you have to run the pro formas each quarter at the end of your decision making, because these pro formas, when you run your decisions pro forma before you submit, will point out to you specific gaps and potential problems in your decision making. You can also have debt financing through other financial institutions which buy long-term notes. These long-term notes are bought at about 2 points over conventional bank loans, and the acceptable debt capacity for your long-term financing is 2 times the firm's equity position in the previous quarter. The long-term debt is for 5 years, and the financial institutions usually don't call in the note due to short-term swings of income. So you have debt financing short-term through banks, and you have debt financing long-term through other financial institutions. Now, bank is intolerant of your financial performance if it's poor. So if a firm ends a quarter with a negative cash position, the bank will contact a loan shark to obtain an emergency loan to cover the firm's checking account. That is a problem, because the loan shark requires repayment in the next quarter, and the emergency loan interest rate is a sliding scale which begins at 10% per quarter and might go as high as 25% per quarter. For each $100 the loan shark places in your checking account, he will take 1 share of your stock from your firm. The issuing of stock to the loan shark causes, of course, a dilution of your stock holdings and stock value and your share in the company. So it would be fortuitous to avoid the loan shark getting involved with you. Let's talk about bankruptcy for 1 second. A firm is, of course, technically bankrupt if its cumulative losses exceed its equity investment. That means your management has used up all the equity of the firm and now has negative value in returned earnings. And the negative value in returned earnings exceeds the value of the common stock. That's a problem, because if you are not able to avoid bankruptcy, you will have a hard time getting a good performance for the simulation and performance evaluation for the course. If you're going into bankruptcy, the mentor and coach for the course, that would be me, will be talking with you and see what can be done. If you are really bankrupt and there is no way out, the best case scenario for your grade in this entire course could be a C, if all the other work that you have done is exceptional. Let's try to avoid that. And in the number of years that I've run the simulation, I had unfortunately only 2 bankruptcy throughout all the courses that I have facilitated. Hopefully we will not have a bankruptcy in our course. Last but not least, I would like to talk about the performance evaluation. So we really want to make sure that you show your strategic thinking capabilities, as well as your technical analytical capabilities in the executive briefings that we have. The executive briefings are really designed for me, the chair of the board, to understand how your managerial leadership team is prepared to tackle the challenge of the simulation. And while we have only a short amount of time in our executive briefings, I expect from your team to have a very clear analysis of previous results under your belt that you can explain, as well as showing to me how that analysis has influenced your decisions for the quarter. The president of the team will lead the discussion and will start the discussion with a brief overall executive summary of where you are, and then hand it off to every single team member who will talk about their specific portfolio of responsibility. Everything needs to be done in a very fast-paced 2-minute per person structure. You will have to have a PowerPoint or two to show through graphs, analytic graphs, on what you're talking about and why you're doing certain things. And I will be asking questions to really gain an understanding of whether you are really in charge of your resort and know what to do. You also have the balanced scorecard, that is a performance evaluation tool. Don't be afraid of having no good results in quarters number 3 and 4 when you go into the test market and see the results. The balanced scorecard will only be evaluated for the last 4 quarters. That will be quarters 5, 6, 7, and 8. And I'll go and talk about the specifics of the balanced scorecard in the next slide. The business plan will be evaluated for your strategic and tactical synchronization. The report to the board will be evaluated to make sure that you really have a good evaluative hold of what happened in the course and the 8 quarters, and show me your analytic evaluation and synthesis skills to prepare some outlook for the future. And hopefully these multiple performance evaluations prepare a very good portfolio for a holistic evaluation of your performance. Let's talk about the balanced scorecard. We are not interested in just looking at financial performance or not interested in just looking market share. We are looking in a sustained, successful business enterprise. And therefore, we're working with a balanced scorecard, which has about 9 portions to it. It starts with the regular culprits of financial performance, marketing effectiveness, as well as creation of wealth. But it also has issues of financial risk, asset management, manufacturing productivity, human resource management, and investment in the future as evaluative characteristics. Be sure to look up the specific levers for the balanced scorecard in the simulation. I will point them out to you in the appropriate quarters, because these levers will actually help you in your decision making when it comes to improve your overall performance. There are formulas for every single lever, and these formulas are explained in depth, and they are reflected in your decision-making capabilities. So the cumulative balanced scorecard score will be the ultimate performance evaluation for your firm and how well you did compared to your competing teams. As I just said, we don't want to get caught up in just market share and short-term profits. We want to make sure that we look at the long-term viability of your firm, and therefore we are using the balanced scorecard because the balanced scorecard, as I just described, measures both long-term and short-term criteria. And if we look at the overall performance of a firm, our managers, the managers that we are trying to create in our programs, should be really versed in all areas that were measured. So I conclude the introduction going back to the mental discipline of our simulation. It all starts with the environmental analysis where you assess business conditions. And these business conditions are assessed on the function level in regard to market conditions, in regard to manufacturing conditions, in regard to the human resource conditions, and in regard to the financial conditions for the market and your firm. Your assessment of these functional levels will actually influence your strategy through objectives that you would like to achieve in your marketing tactics and strategy, in your manufacturing objectives that should be synchronized with your marketing objectives as well as human resource and financial objectives. The business strategy then leads to a business performance that is really also a function of the competition and therefore not completely under your control. And that means that you probably have a feedback loop, which means that you have a strategy, you implement your strategy based on competition at the business level. You need to assess the business conditions again, which will lead to a change in business strategy. That business strategy might not change very much. You might have a very good strategy that can be kept almost intact throughout the game. But in my experience of running the simulation over the last years, I have seen that some strategies, especially for firms who have started with a strategy that might not be effective for that specific simulation and that specific course, need to really be changing strategy based on assessment of market conditions rather fast. Don't wait too long. If your feedback, which is your business performance, does not live up to your expectations. That's it for the introduction to our simulation. We are going to then look at our specific quarter decisions and the preparation for these decisions.